All right, so pretty important video here. How do you value a business? And what does that even mean, right? I think a lot of people, from my experience, are always wondering, well, how did you come to that value of the price for the purchase price? How do you determine that yourselves? Is it similar to real estate where an appraiser comes in, they run market comps? Because that's the route that a lot of people are familiar with, right? So if you want to sell your house or buy your house, you're going to have an appraiser come in. They're going to set that appraisal price and they're going to run market comps for other houses in the neighborhood. And typically, more times than not, the purchase price of that home is going to fall within a pretty tight window of where that appraisal came in or where the market comps came in. Now, with businesses, it's a little bit different. And I'm talking about just the businesses because if you buy a business and the real estate, obviously the real estate's going to fall in line of where that appraisal comes in and market comps for similar buildings in that area. But I'm talking about just the business. Okay, how do you value a business? And so that's what I want to cover here. I'm going to see if I can figure out this slideshow. There we go. So businesses are sold. I'm going to move myself over here. Businesses are sold on a multiple of what they earn. It's just a multiplier. It's multiplication, right? So it's a multiple of their earnings. So businesses are valued off of their past performance. There are other ways to value a business, such as projected earnings. Sometimes people will build out pro formas, which is their projected income for the next 12 months. And usually people are not buying businesses off projected earnings. Very rarely that is done. Most times, 98, 99% of the times, a small business will be sold based off of what they've already earned. And as you can see here, businesses are bought and sold for a multiple of what they earn. The multiple is typically applied to last year's financials, the trailing 12 months, or an average of the previous 3 years. And that's the thing with buying businesses. There is no set structure. It's not that it has to be off of the last fiscal year or calendar year. It has to be off the last 12 months. It has to be off the last 3 years. It's really up to however the valuation company or the broker wants to value the business, where they want to put more emphasis or put more weight on a specific performance numbers, right? And so that's why it's good to know this information, because if you're looking through listings and you're trying to determine, like, how is this valued, right? And then you finally inquire on it and you sign the NDA, you can now look at the P&Ls and you can find out yourself, how do they value this? Do they value this off of last year? Do they value this off of an average of the previous 3 years? How are they valuing it, right? And it doesn't mean anything on how they did it. It's good to know, because if they're going to put all of the value on just last year's performance, because maybe the 2 years prior to that weren't as good, and so they're going to say, hey, look what it did last year. It did really well. We need to sell this business for, this price because they did really well last year. And you might go, well, hold up, let's look at the last 3 years and let's take an average of that and let's bring it down a little bit more, right? Now, I'm going to get into that because it's not all about gouging for a price, or it's not all about getting the cheapest price, and I will explain that in this video. But I just want to first cover how businesses are valued and what is a multiple and how multiples are applied. So there you have it. They're typically valued off of their earnings, their previous earnings, and there's no set structure. It can be the last 12 months. It can be the last calendar year. It can be the last 3 years. And so it's really up to how the valuation company wants to do it and what they think is fair. Sometimes they'll take the higher one, and sometimes they'll just take what's fair and apply a multiple to that. All right. So here's where I kind of wanted to get into the example of that. So let's take this random business. I just made up these numbers, and we've got their profit and loss statements, and we're looking at it, and their net operating income for 2021 was $250,000, and their net operating income for 2022 was $252,000. So they increased $2,000, pretty much stayed stagnant. And then 2023, they jumped up to $278,000. So good income. The numbers sound good. That's a good, cash flow to have. But I want to show you the different ways you can value a business and why it matters. Because as you can see down here, if you're scrolling and you see the list price for $834,000, Well, you can figure this out and do the math if you already have the P&Ls. Obviously, this is hard to figure out just looking at listings. But if you look at a list price and it says 834, and you have the profit and loss statements, well, that's based on a multiple of 3 for last year. Now that makes sense, and I as a business broker, I would understand why you would do that, because look at the previous 3 years. The last year was the best performing year, or 2023 was the best performing year. So I'm going to weight that year more heavily than the other 2 years. And so if you apply the 3 multiple to 278, it gives you $834,000. And so just a little behind the scenes for you is when a business owner wants to sell their business, this is a pretty big conversation between the business broker and the seller is, well, what do we list the business for, right? And so what will happen is the business broker, either they're going to run the valuation in-house or they're going to shell it out to a third-party company. And this is a pretty important conversation because a lot of the times the seller has a certain number in mind that they want to exit at, right? They want to walk away with a certain amount. And of course, everybody wants to sell for the highest possible price. And so this is the conversation between the broker and the seller. And if the broker's good, they're going to set realistic expectations. If this was listed for $1.7 million, that's not a realistic expectation. I guess it depends on the industry, but let's say a 3 multiple right here. That's being realistic for the industry that it's in, for the size of the business that it is. And the list price was still the 1.8. That's unrealistic, right? And so it's the broker's job to bring the seller back down a little bit and say, hey, look, you're going to get lowball offers. You might not get any offers. People might pass this up. They might just laugh at it because it's unrealistic. And so a good broker will bring the price back down to realistic expectations. And so a lot of the times, if you're looking at listings on market, they should be within a realistic range. There's not really going to be many that are going to try and pull one over on people because people are smart and they see what it is, especially once they get into due diligence and they're bringing on their accounting team and their deal team, and they're all going to look at it. And all these advisors are coming on board, and they're going to weed this out real quick. So going on a tangent here, but I just wanted to show the different examples. So let's say that a seller says, well, Mr. Broker, I just really want to walk away with $800,000. And maybe they're calculating in capital gains tax, because capital gains on a sale of a business is around 20%. So I don't know the math here, but let's say that 20% of 834 is 800, and they're like, that's what I want to walk away with. So they're going to boost it up a little bit. They're going to wait the 2023 year because it's the highest year. And that could just be a strategy, like, right? Let's start high and let's weight heavily 2023. So just so you're aware of what kind of happens behind the scenes. And then let's look at the next one. Let's say it's listed for $780,000. You're going, well, it's the same numbers. The P&Ls are the same. So why are they listed differently? Well, this broker or this seller or this valuation company is basing it on an average of the last 3 years. So what they're doing is they're adding 250 plus 252 plus 278, and they are dividing it by 3. And then they're multiplying it by 3. They're dividing it by 3 because they're taking an average, and then they're multiplying it by the 3 multiple, right? So this list price, in my opinion, is a little more realistic because you're taking a larger sample size. You're taking an average of the previous 3 years, and you're not just taking it off of, you're not just weighting 1 year heavily because they had a great year, right? Let's look at an average of all of them and then apply the multiple. So just an example of how the range is so much different than real estate, and it can jump all over the place. So what are multiples? Why was I talking about 3x down here? How did I come up with a 3x? Small business multiples are typically between 1 and 5, and they can increase based off several factors, such as years in business, their earnings, and then the industry and the demand, right? So these can't increase it too significantly, but maybe like a quarter point, right? So, and then obviously I said here, research the industry multiples, Google and Biz Buy Sell. And so I'll just show you, I'll back out of here. I have these all pulled up. If you go to Biz Buy Sell and you type in multiples, Biz Buy Sell multiples, this is a report from previous deals that have already closed. So it's not an accurate assessment of the current time because it's all based off deals that have already been closed in the past, and some things might have changed by now. But if you just look at this and you right here, this middle column, the average cash flow earnings multiple for automotive and boat is 3. For beauty and personal care, 1.9, 2.5, 2.2, 3. So as you can see, falling well within the 1 to 5 multiple range, falling right in between the 1 to 3.5 range, going all the way down. Preschools, 3.5. Marinas and fishing, selling at a 3. Insurance agencies, selling at a 3. Assisted living, selling at 4.35. So as you can see, a lot of these multiples are falling right within that 1 to 5 range. And honestly, it's probably going to be a 1 to 4. And then you can see on the right-hand side what is the median sale price. So what is the price of the business that it was purchased at, and then at what multiple, right? And then you can see right here, revenue multiple. A lot of people don't go off of a multiple of the revenue. It's usually a multiple of their earnings. So research this, look through this, and then you can kind of find your, like if you want to find if you're looking at a manufacturing business and you're like, okay, well, what do they sell for? Well, you can see right here, they previously have been selling for 2.9, but that's for the average median sale price of $700,000. So keep in mind, like I had said, multiples can increase based off several factors, especially their earnings. And their earnings is probably the biggest factor that can increase it. And so once you get over that $1 million earnings, or EBITDA, which is your earnings before interest, taxes, depreciation, amortization, once you get over that $1 million of earnings, that's when the multiple starts to creep up a little bit. Anything in the tech or SaaS industry tends to be a little bit on the higher side just because of demand. So if there's industries that have higher demand, maybe it's a little bit of a bump. It's nothing too crazy. The biggest driving factor of why a multiple would be higher is because of the earnings. And so when you hear some of these companies that are selling for, hundreds of millions of dollars, their multiples are up in the 8, 9, 10, 11, 12. I think a lot of the tech companies, when they were trading a couple years ago, were well into the double-digit figures. So it just goes to show you that the earnings is a bigger driver for the multiple. So going back to the manufacturing example, the average sale price at $700,000 was selling for 2.19. And I'm going to show you a little bit more examples on this, but I also wanted to show you this. I had Googled what multiple do HVAC companies sell for. And you can just Google something, and I found this report right here. These are all HVAC companies, and you can kind of find let's say you're looking at one and you find one that does mainly commercial, heating, cooling, and all purpose, right? But now you're seeing EBITDA multiples, which is still your earnings multiple. You're seeing them up in the 5s, and you go, Jordan, you just told us that multiples are from 1 to 5, and when the earnings increases, the multiple increases. Well, that's exactly it, because if you look at the earnings column right here, this is $500,000 earnings minimum. Now, I said usually $1 million. They've shown it $500K right here, which is still pretty good. But as you can see, the larger your earnings gets, from $500K to $1 million, from $1 million to $5 million, from $5 million to $10 million, the multiple starts to increase. So you can see 5.6 to 7.5 to 8.5. So the more your earnings increases, the higher the multiple gets. So if you're looking at a bigger business, you might see a little bit tiny hike in the multiple. So that's what a multiple is. That's how they're applied. That's why they're different. There is no set in stone. Like, nope, we're using a 3 multiple for the year of 2024. It doesn't work like that. I know it might be confusing, but just know that this industry is not like real estate. There's no set in stone process on how this works. So let's go back into slideshow mode. So how to determine what multiple was used. So you take the asking price and you divide it by the earnings, whether it's cash flow, EBITDA, SDE, or the net operating income, And let's just go back to biz, buy, sell. So let's use this manufacturing line again. So this is the earnings, or this is the multiple based off revenue, which we're not going to use. It's very rarely used. This is the column we want to use. So manufacturing businesses sell for about 2.91 multiple, and the median sale price is $700,000. So if you take, let's use our calculator here. So if that's the list price, right? That's not the earnings. So if you take $700,000 and you divide it by 2.91, that was the earnings right there. So again, what I was saying in the beginning, you don't know how they valued it. Like, is this 2023? Is this 2022? Is this an average? What is this? We don't know. We just know that their earnings are going to be around $240,000. So that's pretty good. It's good earnings. It's a good multiple. It's a good list price. Everything there seems fine to me. And so that's how you can kind of figure out what their earnings are. That's how you figure out what the multiple is. And I just think it's valuable information to know. So if you're scrolling through biz, buy, sell, and you're trying to look at, some of these businesses, and you're taking the purchase price and you're dividing it by the cash flow, and you're going, okay, it's a 3. Like, let's just do this one for example. So let's take this established unique spa, and it's $1.9 million, and the cash flow, their earnings, 551. So what I'm looking for when I'm doing this is just, I don't want to see like a 7 or an 8, or just something ridiculous. Like, I'm hoping that this is going to fall between a 1 and a 5, and ideally right around a 3 is the comfort spot. So 3.4, there we go. And so then I would go, okay, this is a spa and wellness center, 3 multiple, seems pretty fair to me, honestly. But I'm going to do my research, and I'm going to try and find beauty and personal care, 1.9. I think there's a spa category. Spas, 2.31. So, and again, but here's the thing is, I don't want you guys to go back to the seller and be like, well, multiples are 2.31. Because look at the median sale price for this, $190,000. So this is significantly smaller than the business we're looking at right here. Because if we go back to this, I'm just gonna do like run all these numbers on here just so we can all see it. So if we go back to this spa, median sale price, and this is an average of spas. But if we take the median sale price of $190,000, and they said that the median multiple was 2.31, so 2.31. So the earnings for that were $82,000 a year. Whether that was an average or last year, $82,000. This is 551. So it doesn't increase much, but it increases the multiple. Like I was saying, it increases it maybe a quarter point or so. So let's go back. Let's take a look. 2.31. What did we come up with? We were at 3.4. So yeah, that's pretty accurate. It increased a couple quarter points, almost a full point. So that, sorry, I'm jumping all over the place. That listing price and asking price, pretty spot on in my opinion. 3.4, totally cool. Okay, let's get back here. So what does all of this mean? I'm going to jump back into the slideshow again. So I show you all these different ways a business can be valued because you can use this to negotiate for price or for terms. And what you want to do is you want to find out what the seller wants and structure a win-win deal around that, right? So if you're trying to structure for price, meaning you're trying to get a cheaper price, you need to be prepared. You're probably going to have to give up on some terms. And what I mean by terms is it might be a little bit difficult to negotiate seller financing, maybe a training period or a transition period with the owner, a deposit amount, working capital amount, non-compete, closing date, etc. Right? There's all these different deal terms that are going to be put in the LOI and the purchase agreement, where it's just like anything else in life. You can't just ask for everything and bulldoze your way into getting it all. You have to create this. It's like a dance of, I want the cheapest price. So maybe I get on this call with the seller and find out what they want, right? What is their goal that they're trying to achieve? Are they trying to just get out right away and retire? Are they looking for a big paycheck? Or do they really want their business to stick around and their legacy to carry on, right? So that's something you can find out in the introduction call with the seller. And if you can kind of get a sense of what they're trying to do, and you know your goal is, look, I'm just trying to get the cheapest price. None of the terms really matter for me. So you have to listen to the seller and see what they want and start to structure around that, right? Maybe they just want to get out right away. And so you're going, okay, you want to be out right away. That's fine. Maybe I don't, whoops. Maybe I don't ask for that much of a training period right here. So you know what? You want to retire? Go retire, but I'm going to value the business like this, and the price may be a little bit lower, kind of like this. Maybe you take this bottom approach right here, and they had it listed at 834. You go, okay, cool, and you find out the seller just wants to retire. They really just want to get out and they're done. He wants to move to Florida and just be over. You go, okay, I can get you out of there. I don't need you for a 2-month training period. I'm taking a look at the financials here. I see that you absolutely crushed it last year. I'm going to take an average though because I want a larger sample size, and so I'm going to put an offer in at about 780. One little recommendation here is always run this by the broker first before submitting an offer. And just say, hey, I'm going to come in at about 780. I took an average of the last 3 years, applied a 3 multiple to it. Seems pretty fair. And I wanted to do this because I heard that he wants to retire and just get out. I'm not going to ask for too much of a training period, right? So it's that delicate dance of finding out what they want, giving it to them, but you're also secretly getting what you want as well, right? So that's negotiating for price. And kind of a cool tactic you can do here is you can find out what multiple they're using. For example, if we go back to this spa right here, let's say you wanted to buy it. It's $1.9 million. Cash flow is 551. Well, they're using a multiple of 3.4. We just did that math. So if they're using a multiple of 3.4, and let's say, try and stick with me here. So let's say that this is the spa example right here, and these numbers are all not correct, obviously. But you're using a multiple of 3.4, and let's say that they base that off of, they weighted it off of their highest year, their highest earnings year. And you can use, and then once you get the financials and you take an average of the last 3 years, and you still want to use that 3.4 multiple. Do you get what I'm saying? So basically it's like using their own words against them. And that's not what it is, but it is. So you're saying this business should sell at a 3.4 multiple. Okay, fair. And then you come to find out, well, they weighted it off of 1 year. They took the best performing year. Let's say last year it cash flowed 551, but the year before that it was 520, and the year before that it was 505. So then what I would do is, if I'm trying to negotiate for a cheaper price, I'd go, I'll use 3.4 multiple. I think that's totally fair, but I'm going to take an average of the last 3 years. It's a little bit bigger of a sample size, and I'm going to take an average of those numbers and then apply the 3.4 multiple to it. Because then that way they can't negotiate the multiple, and you're taking an extremely fair approach of averaging the last 3 years. You can't put all your eggs in the basket for one good performing year. You see what I'm saying? So that's kind of a good tactic, if you will. And let's jump back here. So let's say you wanted to negotiate for terms. So that means you're possibly giving up getting the cheapest price in order to have more favorable terms, such as seller financing, less deposit, stronger non-compete, more training, more working capital, etc., etc. So what do I mean by that, right? It's just like anything else when making a deal. You can't have it all, like I have mentioned before. So you need to figure out, what do you want and what does the seller want, and start to structure something around that, right? If you want more terms in there, let's say you maybe want to add some seller financing and you want a little cheaper deposit, and maybe you want a stronger non-compete, or you want a larger training period, meaning when the deal is closed, the seller stays on board to help you with the transition for maybe a month. 2 months is kind of asking for a lot, but maybe you need that full month, or you want 2 months, and you say, you know what, I'm willing to take line item 1 right here. I'm willing to give you what you're asking for. In exchange for that, Do you think I can get a little bit of seller financing? Maybe that'll help with my down payment. Do you think I could do a little bit less of a deposit or a stronger non-compete or more training? So you can dictate the terms a little bit more now because you're going, hey, I'll give you what you're asking for. It's totally fair for me. I ran the numbers. I like it. I'm on board with the price. In doing so, I would like to have a little bit more stronger training period or working capital, seller financing, whatever it is, right? So I know this is going on a little bit long. I'll wrap it up here. So, as I said, if you can find out what the seller wants, you will have some leverage on how to structure towards your goal. Do they want the highest possible exit price? Are they trying to sell sooner than later for retirement, relocation, etc.? Or are they not in a rush and they just want to make sure that their legacy stays? So, this is really going to come in on the buyer seller introduction call. And it's one of the first questions I ask, and I think it's one of the first questions that I put in here for example questions for you to look at, is why are you selling? Tell me why you're selling. What are your plans after the sale? When did you start this business? How did you get into it? Really start to figure out who the seller is and why they're selling, what they want to do after this, because then you can start to get a sense of what do they really want out of this. Right. And I used these examples because that was really the main ones that I saw when I worked with sellers, was that some of them just wanted the highest price and some of them wanted to retire. Some of them maybe had health issues and they just wanted to get out. I had someone who was fairly old. He was in his 80s and his son worked in the business, and he just wanted the business to stay running and his son to have a job, and he wanted to retire and go fish and be done, right? So obviously he wanted the highest price possible as well, but he mainly wanted for the doors to stay open and for his son to keep a job, right? And obviously I didn't tell the buyer that, but again, it's a little bit peek behind the curtains where there's always a main objective the seller is trying to achieve, and it's your job to figure that out, right? And so maybe you ask, like, did you have any kids? How come, did your kids work in the business? Or how come they didn't want to take it over? What's going on with that? And so that's why I put those examples there, because they're the main ones that I heard when people are trying to sell their business. So again, I'm going to wrap this all up. I apologize for rambling. I just want to cover everything here. Find out what the seller is trying to achieve. You know your goal. Are you trying to save money? Are you trying to get some better terms for you? And start to structure it that way. And then just play around with the numbers and do your research on the industry you're looking at. I will say, just like quickly glancing at this biz buy sell stuff, these do seem on the smaller side. I typically see these are good multiples right here, 3.3, 3.5. That's usually what I typically see. But these are also smaller list prices for some of these industries. Towing companies, $1.1 million, 3.23. That's pretty accurate. That seems pretty fair. So do your research. Look around at what you're trying to do. As you can see, car washes here, 5. That's because the demand is so high. I will tell you that. Private equity goes after car washes pretty heavily. But just go through biz by sell and, take the purchase price, divide it by the cash flow, and go, okay, that's selling for a 2.7. All right, sounds good. And then, do some Google research and look around. This might not be the best example because these are talking about 500K and up for earnings. But that is the video on how to value a business, how to get a little creative with it, how to find out what the seller wants, to structure a deal around what you actually want. And then just to make sure, I think more importantly, that you're not getting screwed over, right? You want to make sure that you're going to offer something in a valid range. If it falls between a 1 and a 5, you're in a good range. If it's right around that 3, I think that's typically what you're going to more likely see. So I'm going to end this video here. Again, any questions, put it in the discussion group, and I will see you in the next video.